Hi everyone and welcome to another quick take video. Today we are looking at Rio Tinto. So Rio Tinto is an Australian mining company. It has a few focuses on iron ore, aluminium, copper, diamonds, energy and minerals and other operations. So it's operating in Australia. It's managed operation in Australia, Canada, Mongolia and the United States, and some operations in Chile and Indonesia. So the company, from investing.com, it doesn't seem like we have the latest kind of data, or maybe it hasn't been released, but that's for 2020, so nothing's been released, so which is a little bit odd. Anyways, a little bit slow. Sorry, not odd. Some company does take a while, but yes. But I'm showing you on investing.com, but definitely go. After this, I probably will look at my own brokerage firm, because I'm not allowed to show information from there. That's why I have to use investing.com. Anyways, PE ratio looks really good, 19, while the industry is 28. Like I've said before, the sweet spot is around 15 to 30. So it's nice to see that such a big company, it's an Australian blue chips company too, you have such a nice PE ratio. Quick ratio, it's showing that it has some cash to last for at least a year, a little bit more than a year, so that's always a good thing, and especially impressive for such a big mining company too, because they have a lot of overhead. So to have enough cash to last a year and a year and a little bit more is quite impressive. And it does have a dividend yield of 5%. Again, that is quite impressive, considering like banks only pay less than 1%. You can just quickly double check that against on ASX.com, just to make sure that is current. So it's 100% franking and it's around 5%. Again, that's really good yield. All right, moving on to the cash flow. Again, the data here is the latest is 2019, which is a little bit annoying, but we work with what we have. Operations gone up in 2019 compared to 2015, 18, so which is a good thing. Capital expenditure hasn't grown that much since the years before, which is again very impressive. Financing, so a lot of that money is actually paying out dividends, and I'm expecting this year, 2020, to be pretty much the same. And I think the dividends is what stopped it from really dropping too much, and we'll have a look at the chart to see how much it dropped. And it's paying back its debt. Again, I mentioned this a few times, with RBA keeping the interest rate so low, it would be nice to see that it probably hold off on the debt repayment, or unless those debt has a fixed term and fixed interest rate, which they happy for them to pay that off and borrow a little bit more money on this cheaper interest rates. Balance sheet for the year before, it dropped down, so but overall it has still has a lot of cash and short-term investments on hand, so cash and cash equivalents. And I'm just having a look at the current liabilities. It's hard to say it's current liabilities, and because in 2019. But anyways, from the look of it, it's kind of like just hovering around the 10 billion, 11 billion mark. So 2020 might have, hopefully it's pretty much the same, but with the asset probably, hopefully the asset will go up, especially, let me see, hopefully some things like it's iron ore, it's inventory, actually maybe its inventory might be gone up because of the iron ore price has gone up tremendously in 2020. Income statement, revenue has gone up in 2019 compared to 2018. Again, it's really annoying to do analysis on a company without having the latest data. Income for 2019 has dropped, but I'm expecting 2020 to be much higher, just because of the surge in demand for iron ore, with the economies recovering and all of that. With Australia in a kind of trade war with China, and the whole supply chains being disrupted, the iron ore prices is really keeping the Australian economy afloat. Okay, jumping straight over to the chart. So I've analyzed a little bit earlier. I just drew out some main trend line to see. So then we save some time. So we can see that it's testing its more than 52 weeks high. The highest point it's ever had is around this point here. So this is the GFC. That's what happened there. So it went up to $23. So that's around 10 years ago. And 10 years ago, if you bought it at that point and it came back up, you'd be laughing and sell at that point there. Anyways, it does look like kind of cyclical kind of company, and mining companies tend to be cyclical just because they'll grow during great economic activities and they'll fall during slower times. And it's expected, especially when you're exporting. When you're mining for resources which are crucial to development and constructions like that. So I'm just a little bit wary. If this particular high is being tested? It's obviously being tested and dropped back down, and it's coming up for another test. And if there's a breakout, it might continue upwards. And it's hard to tell from this point where the resistance here, because it never really formed any higher point. So but with the amount of cheap money lying around, and there's definitely almost a bubble like kind of action in the economy, I'm expecting it to break out, go up, and then kind of retrace. But if it doesn't break out at this level, it would definitely move down to either this level, there's a support there, or even a little bit further. If it retraces beyond that, we'll get down to this level. There's another really strong support that extend all the way to this particular high here. So let's check a Fibonacci retracement on that, and I'll give my conclusion to this particular company. So yeah, you can see that all of these highs and lows really fit well with the Fibonacci retracement level. So here's the 78, which we tested, and then here this particular resistance is was sitting at the 61.8. So we're following a really predictable kind of retracement pattern. So I'm expecting to see it tested again, so double top, but then it will drop down. But then I'm watching the volume to see what happens during this breakout here. So if it's a small volume, it might just be a fake breakout. But if it's a big volume, that's mean that institutional investors kind of really trying to push this up. So I would put this on my watch list, and to review very, very frequently for the next weeks or so, just to find an opportunity to come in. And with the great dividend payout, it is actually quite attractive, but it's just there's a lot of risk buying it up to this particular point. So I wouldn't say buy it yet. If you already have it, I would say hold and don't buy anymore. I wouldn't say sell it yet, just because you don't know. I guess depending on where you bought it. And so if you bought from down here, I wouldn't sell it yet unless it probably retraced back to a really major in a major way. But if you bought it probably here, you probably want to consider just taking out some of that profit and let the rest run. But yeah, even at this point, you can do that too, at this low point here. But here's the 2020 dip, went back to 73. It's almost doubled its share price. So that's really, again, that's a tremendous amount of growth for the share price. And that's, yeah, so at the moment, it's definitely really close eye on this particular company. Watch out for retest, and watch out for a breakout with a high volume, and watch out for indications from the MACD, as well as hopefully a report will come out sometime soon, and with maybe an oversold on RSI. But yes, that's pretty much it for today episode of Quick Take. If you like what you see, please share, like, and subscribe. If you have any other points you want to point out regarding this particular company, please leave that in the comment. And I guess a question for today: what is your trading strategy? How do you know when to enter? How do you know when to exit? So that's a great discussion to have for a lot of amateurs investors. I do have my own strategies, and I guess we could discuss that a little bit later in another video. But let's keep this short and sweet. Thank you so much, everyone. Have a great day. Take care.